investor sentiment has shifted. Many folks will tell you that it was quote unquote easy to raise capital in recent memory. I don't like to say that because I think it discredits the approach to raising capital. Certainly, you may get yeses a little quicker than in the past, but I don't like to use the word easy. I don't like to use the word hard either. So the truth of the matter is, maybe it didn't take as much effort in the past. It's going to take more effort now, which means you need to have more conversations with people. You need to educate people more. You need to let them know why now is a good time to invest, even though everything you read in the news says it's not a good time to invest.
If you're a real estate agent earning $200,000 a year and you want to grow your passive income, this show is for you. Learn secrets other agents use and hear from experts in our field who will guide you on your journey to investing in assets like apartment communities so you can take your commissions and turn them into cash flow. Here's your host, Randall. Let's dive in.
All right, welcome back. Today's guest is John Casmon. He is a multifamily operator, capital raiser, syndicator, buying properties in the Midwest and in multiple markets. We have a great conversation. He is well-spoken, easy to converse with, and his way of explaining concepts is incredible. And we talked about this just a minute ago off air as well. So you're going to get a lot out of the show. Some of the things we talk about, one, are capital raising, how he went from buying a 2, then a 3, up to partnering and raising capital for a 192 unit deal in a very short time. And the 3 C's of raising capital that you will need if you're going out and you're starting a syndication business. Then we talk about his deal flow and how he, again, bought that 192 unit and what it looked like to go through that process, buy another portfolio of 390, and just multifamily in general, the market right now, what it's looking like, and what they're working on in the future. So if you're getting something out of the show, please go on, rate and review. Helps us a lot to bring guests just like John on. And let's jump into the conversation. Here we go. Hey, John, welcome to the show. It's great to have you on today. Excited to talk to you about what you're working on and kind of the trajectory that you've had in your real estate career. So why don't you just go ahead and give us a quick background, how you got from your profession into your real estate career.
Yeah, Randall, excited to be here and share a little bit more information, right? So to give your audience a little background on me, my name is John Casmon. I am a Cincinnati resident, but I'm born and raised in Cleveland, so I'm a Clevelander, proud Ohioan. I am an investor who has accumulated $125 million worth of apartments with other investors. And today we syndicate. We partner with other investors, busy professionals, and pool our money together to buy larger apartments. The way I got into this was actually I had a background in marketing. So I was in corporate America doing advertising and marketing. I did that for about 15 years. And I worked for a couple different companies. And unfortunately, or I guess fortunately, depending on how you want to look at it, I worked for companies that also went into bankruptcy. So picture having your W-2 job, your 9 to 5, you've got this income you can rely on, but that company goes into bankruptcy. And these are not small companies. One was General Motors. So huge corporation, very public situation. And I was right in the middle of it. Fast forward, I realized that I wanted to invest in real estate to give me a little more flexibility. Started investing in smaller multifamily, bought a 2-unit building or a duplex. So I was a guy who just had, a 2-unit building, started buying a little bit more, bought a 3-unit, bought an 8-unit building. And then the company I was working for at that time also went into bankruptcy. So at that point, I realized what I was doing was on the right path, but the specific strategy wasn't enough to kind of insulate myself from these outside pressures. So I needed to make a change and ultimately learn more about apartment syndication and started working with other investors.
So what year was that when you made that shift that you were buying the 2-unit, still working, and then transitioning out?
Yeah, that was around the end of 2015, early 2016.
Good time to start apartment buying. So you transitioned from the 2 units. Like, what was that trajectory like? Because I'm again kind of curious. I know that you have a mentor, Joe Fairless, right? And did you start that mentorship right when you were trying to get your legs running in the syndication world, or something else? Like, how did that work out?
Yeah, it's a great question. So, it's interesting because in some ways, I didn't feel like I needed a mentor starting out. And because I really didn't know where I was going, right? I had this plan, I had this vision. I'm a hard go after kind of guy, right? So I was reading books and attending meetups and reading blogs and stuff like that. And I bought that 2-unit building without a mentor or coach or anything like that. I bought that 3-unit building without that. And what started to happen is, okay, I'm having some wins, I'm having success. Right around the time that second company went into bankruptcy, I bought an 8-unit building. And my wife and I, we would save our money by these properties. So we bought this 8-unit building. It's a commercial building, first commercial property I wanted some experience managing the manager, but we're not running this like a true business, right? Like we've got P&L. I'm trying to make sure everything is running smoothly. And the company I went for went bankrupt. And I had just, wrote a six-figure check. And not to mention, we had just had our second child. So I'm sitting there and we got, we're equity rich on paper, right? But the truth is, I was super concerned about the cash flow and how long we could go while this company thing got situated. And as I worked through that, I realized, well, what I'm doing, it works, but not if I'm only relying on the amount of money I've saved. I've got to find a different way. And that's what made me really consider working with other people, right? So OPM, other people's money. And I kind of randomly met Joe. And what really opened me up was that summer, I attended one of those like TV guru boot camp type things, right? And these guys are getting super excited about joining their program. And we got all the systems and processes. And everyone was like, yeah, this is great. Oh, yeah, go 1, 2, 3, crush it, right? So we're all super excited, the crowd, right? And energy's high. And, by the end of that first day, they start pitching kind of their program. And my wife and I are talking about it. We go home that night and, should we do it? What do you think? I don't know. It's a big investment. And the second day, we're there and the tone shifts and it goes from a positive, energetic, motivational experience to kind of a hard sales pitch. And there was one thing in particular where the guy got on stage and says, and if you don't have the money for the program, call your credit card company tonight and ask them to increase your limit. I was like, what?
Yeah.
That's got to be some of the worst advice I've ever heard, right? So at that point, my wife and I looked at her like, this ain't for us. Let's get out of here.
Yeah.
And we skipped the third night. And what we ended up doing, and by this point, we had our oldest child. So we had to hire a babysitter to watch our kid while we were at this conference, right? So the third day, we're like, well, we already have a sitter. We know we want to commit to real estate. Instead of going to what we know is going to be the hardest of the pitches, why don't we just go to the library? We spent all day at the library. And the point was, we were trying to really leverage all the resources available to us. I got really active on Bigger Pockets, read some books, but by being active on Bigger Pockets, I started to make more and more connections. And one thing that happened was my wife is from Cincinnati and we were living in Chicago at the time. So I reached out to people in Cincy to say, hey, I'm looking to connect with local investors. About 3 or 4 people tagged Joe Fairless. And this is before he was the guy that we all kind of know now. And I'm like, all right, let me reach out to this guy. And I reach out to him and he responds and says, hey, man, yeah, great. I'm happy to, sit down and have lunch. And he's like, by the way, I got this podcast and I'd love to have you on. I'm like, what? Like, and I go and look this guy up. I'm like, man, I don't be on a doggone podcast. Like, and then I look and he's had Robert Kiyosaki on there and Barbara Corcoran. I'm like, oh, okay, this looks like a pretty legit podcast. I don't know why he wants to talk to me. Like, I got 3 properties, right? I got 13 units total. But I'm like, all right, but you're still gonna have lunch with me, right? And he's like, yeah, sure. So I'm like, all right. So I do the podcast. I go to Cincinnati. We have lunch. He tells me of this coaching program. And we hit it off. We have a great conversation. He's an advertising guy. I was in advertising. He talked to me about how he was able to raise $1 million for his first deal and how he's helping other people. And I thought about that guru conference thing I went to, that seminar. I was like, well, we thought long and hard about writing a $35,000 check. And this was a fraction of that. Yeah. And this was the guy I had a real connection with and had done it. And I was like, let's do that. So that's really how that started. Was I hired a mentor because, again, in that situation, well, now my situation had changed where raising capital or working with other people almost became more of a necessity for survival than just a luxury. But then also I had gone through the process of really considering my options, looking at, free or low cost resources around me. And they only took me so far. And the biggest thing is this: if you're going to raise money or work with other people, most good natured individuals are going to have a little bit of trepidation around that, right? Because we're scared to lose somebody else's money. There's always a fear of losing money. You may also have a fear that maybe people don't want to invest with you. So those are definitely the 2 things that gave me pause or hesitation about going that route. So when I found this guy who had done that and could help me learn how to do it, I thought it was very powerful. So that's ultimately why I ended up moving forward with my mentorship.
Love that story, honestly. So one, you went out, you started buying. You weren't afraid to just go and do it. And now you had a job while you're doing it, so that may help. But I talk to so many people and they just will spend money on a course or spend money on something instead of taking that $35,000 and buying a property. I mean, literally, that's a down payment on a property, depending on the price of the property. So that's awesome. And then you sought out free or relatively inexpensive options to grow your knowledge base. So again, I love that story. Curious then, you mentioned the fear of raising capital or not knowing how. So through the course or through your experience, anyone who's looking to start raising capital now, what are some of the tips that you have to overcome that fear or strategies on how to pitch, those types of things in order to get better at it and overcome the fear of having that conversation with people?
That's a great question, right? How do you overcome the fear of pitching someone else to raise capital for a deal? The very first thing is this, and I tell people all the time, there's really 3 C's to raising capital. First C is going to be confidence. Confidence comes from preparation. You got to put in the work. You got to know your stuff. You got to surround yourself with the right people. You may not have experience necessarily, but the confidence has to come from putting in the work, right? Are you underwriting deals? Do you understand your markets? Do you know how to navigate the landscape? You got to put in the work. So that confidence cannot be faked. It can't be fake hubris. It has to be authentic, right? Based on the knowledge and the work you've put in. The second C is credibility. What in your background gives you confidence that you can execute? What wins can you point to professionally in real estate? And if you don't have a long track record, who else on your team can you highlight? Property managers, partners, mentors, coaches. Those are the people you need to build that credibility. You should not be out there pitching a deal if you don't have a credible team that can go out there and execute, especially if they don't have a track record or resume to demonstrate they have the capability and have demonstrated that capability of executing. Again, if it's your first deal, that's fine, but you need to surround yourself with other people who have more experience. Again, this is where a mentor, or coach, or partners are really, really important. And the third is going to be connections, right? Who are the people you're talking to? If you don't have folks who have the money to invest right now or the relationships, you have to expand your network. So understanding how to expand your network is absolutely key. So those 3 things are what I would focus on, right? Building your confidence from putting in the work, making sure you're studying the right things and learning, growing your credibility, if not from relying on your own experience, both professionally and within real estate, by expanding your team and having the right people there. And then third, growing your network or growing your database of potential investors.
Love it. All right. So we're going to break those down then. Again, didn't know where we were going to take this, but let's take it here. So on the confidence side, for you, you had already purchased 2, a 3, and an 8. And now you're at this step up. You're trying to go bigger, presumably because you're buying something. So tell me, what was the first asset that you went after, and where were you in the spectrum, right? Because so many people I talk to, like me, it's like I want to control like most of the process, right? I want to be the operator and capital raiser so that they're my people, and they know that I'm the one running the show. So, but there are people in our industry who just want to raise capital, people who just want to operate. So where do you live in that spectrum? And if we're going to talk about your first deal, which I want to, where did you live in that spectrum at that time?
Yeah, great question, right? I love the context you put around that question. So let me set this up here. I think the very first thing is to understand that this is a team sport. And that's what you're alluding to, right? This is a team sport. You don't go out there and buy large commercial real estate by yourself. You got to have people around you. So the first commercial deal I did was that 8 unit, which was just me and my wife, our capital. We ran it. We hired a third-party management company. Yep. My intention was to continue to scale like that and just raise a little bit of money. Maybe buy a 12 unit or a 20 unit and raise half of the proceeds, and we would bring half of the proceeds. That was the vision. What I learned quickly was it was much harder to find a 12 or 20 unit where I'm splitting the profits with someone else, where the numbers still made sense. On an 8 unit where it's all my money, I get all the profits. Okay, we can find deals where the numbers made sense there. But also keep in mind that the market's starting to heat up. So those prices started going up, and the way I was evaluating these deals, I put almost all of the focus on cash flow and very little, if any, on appreciation. So as prices went up, these deals just simply didn't work. So as I was looking, I think I spent like 8 months looking for a deal, couldn't find anything. And the beautiful thing about apartment syndication is the next deal I did, I ended up partnering with another group and another operator. And I met this operator through my mentor. He had an event and we went to this event. My wife actually connected with one of the guys. We had dinner with him. And fast forward, I'm launching my podcast. He's talking to me about a deal he's doing. And I'm like, that sounds amazing, man. I've been over here searching for the last, almost 3/4 of a year trying to find a deal, and I can't find one to pencil. And as we start chatting, I realized it's a great market that he's in. I like a lot of what he's doing. We've got a great rapport. And I say, well, listen, man, if I can't find anything and you need help, let me know because I'd really like to help some of my investors. The first deal I did was, or that first commercial deal was 8 unit. The very next one was 192 units. So we did a 192 unit deal in San Antonio, Texas, with guys we met at a conference, right where you're located,
Yeah,
right?
I know, it's my
Uh,
hometown. All right.
we did that deal with them. And the beautiful thing was we were not the leads. And it gave me comfort to kind of attach myself to someone who was a little further along than we were, had a little bit more experience. They were local in that market. So we could kind of learn and continue to grow from them. And then moving forward, we actually started doing deals where we were the lead. And that's one thing I think is really important for people is to have some fluidity to how you grow and scale. If you feel like I got to be the guy, well, it's going to take you a little bit longer and you have a little bit more patience. And the challenge for me, and I was okay with that, but when things really started to shift from my perspective, is when I was talking to some of these investors who, again, I didn't think would want to invest or I was concerned about up front. Well, when I had those initial conversations, I got a much better feedback than I was anticipating. But then they came back to me after 6 months of no deal and said, John, where are these deals you were telling me about? When are you going to bring me something? Right. And I realized, man, I don't have a product. I've told these people I could help them. I can help them get cash flow and appreciation and tax benefits and diversify their portfolio. And they wanted these things, yet I wasn't bringing that product, right? And they still had that problem whether I found a deal or not. And particularly, I had a family member who had a six-figure tax bill problem. And he was like, dude, like, I need this, man. If you got me sold, and if it's not you, I'm gonna have to find somebody else. And I wanted him to be with me, going back to your point about, maybe control. I would rather take that on for myself because I know that I'm going to do more due diligence. I'm going to work a little bit harder. It's not that I can't trust these other people, but if I'm the person who introduced this to you, I also want to be the person who helps you learn how to do it the right way. And I took that as a kick in the tail to say, it doesn't have to be your way or the highway, John. You just have to figure out a way that you can live with that helps the people you're trying to help. And
Yeah.
that gave me the flexibility to do that. And I think it gave me the license to trust and partner with other folks. And then I could focus a little bit of my time on vetting those individuals
Mhm.
while still looking for deals. I wasn't stopping that. I wanted to be an operator. I wanted to lead deals, but it wasn't about me. It was about serving the people I was trying to help.
Yeah. Great. Solid. Like, good explanation. It's one of those things, again, walking through that. So questions around one, I mean, it's in San Antonio. This is a what, 2015, 2016 timeframe?
2016 or 17. I've got to double check the numbers, man. But yeah,
Can you
2016
tell
or
me who
17.
is the operator?
Yeah. It's Wildhorn Capital. My man Andrew Campbell. We did that deal with him back. That we did two deals with those guys. So we
Okay.
did two deals. We did that one, and we did they had a 388 unit portfolio that we partnered with them on as well.
San Antonio also?
Both in San Antonio. Yep.
Okay. You still own those, or you guys?
No, we went full
Yeah.
cycle on those. Did
Yeah.
great on we did amazingly great on the first one. Did good on the second on the portfolio play, but not as strong as the first one.
Yeah. I mean, again, like I said, great time to be buying multifamily.
Oh
Right?
yeah.
Like, you
Oh
guys
yeah.
got on the market at the right time.
Yeah.
Okay. So that was your first deal. Again, the confidence. So you were going out, talking to your investor base well in advance of having an actual deal in hand. You were underwriting deals and you were, I guess, learning through that whole process. So the credibility came in when you partnered up with the Wildhorn guys and they had deal flow. And so then you had this deal. And so then the connections again, how did you grow your network, or did you not need to grow your network? Do you have any tips around that? So if somebody's, again, getting in, they're like, I really want to raise capital and co-GP a deal,
Yeah.
but yet their network isn't multimillionaires, right? How would
Yeah.
somebody go about that?
Well, I think you want to follow a proven system, right? So one of the first things is like, don't just go out there haphazardly and connect. I meet people all the time who want to raise money from doctors, just to use an example, right? Like, oh, I want to raise money from doctors. And they have no connection to doctors. It's like, well, why would these individuals want to invest with you? And they haven't thought through that part, right? It's like, okay, I want to work with high net worth investors. Do you run those circles? Like, why would you think these people would want to invest with you? So I think the very first thing is really understanding, like, who are you uniquely positioned to help? Where can you add value? Who do you understand kind of intuitively? And then when it comes to expanding your network, follow a system, follow a proven system. I have one client who they come from the medical field. So that's their background. They're in the medical field. So what we help them do is really set up a process where it's the same system for most of our investors, but they set up a process for them to engage and connect and expand their network. I'll give you a tactical thing so it's not just so high level. One simple thing is to create what we call a thought leadership platform. So I launched my podcast. Some people do meetups, some people will do a blog post, but you want to create something where you're able to connect with these individuals, share what you're doing, and really strengthen that relationship. So that's really key. There's some nuances of how to do it the right way to be effective so you're not just spinning your wheels. But if you can create yourself as a thought leader and focus on truly helping the people you're trying to serve, that helps you expand your network for sure.
Yeah, good advice. To that point, so you launch a podcast, and do you have outside meetups and other things that you run that kind of bolt on to just build more of a following either on the podcast or some other thing? It sounded like you said one of your clients. So do you have a coaching program or something that you do?
Yeah, so from working with Joe, one of the things that I found is that as I was out there doing these things, the podcast, I do have a meetup that is in Chicago, so I still run that, kind of show up around 4 times a year for that meetup. And then I was doing a conference as well, ended up launching a conference, the Midwest Real Estate Networking Summit. But from that, I was having a lot of conversations with people who wanted to do what I was doing. And at first, I would refer them to my mentor, and as his availability became less and less, and his prices changed pretty dramatically, he just became less and less accessible for them. So, in some conversations with other people, I realized I was already mentoring people. I just didn't have a real program about it. So, I ended up launching my own coaching program. And one of the things that really set me off is I kept thinking back to that guru presentation, right? There's a person out there who is looking for their information. They want to grow, they want to scale, and you want to make sure they're in the right hands. And, they're different groups. You got to pick your flavor, like you might have a vibe with one group. Like that's fine. That's completely fine. But you want to work with people who are active in the space. They're currently doing deals. They're currently looking. They can give you real-time feedback. They understand the advances that have happened in technology. They're having real-time conversations with brokers. What you don't want to do is buy into someone's vision or program that is already outdated, right? Somebody who's teaching you how they did stuff in 1987. That crap probably don't work no more. I mean, look, cap rates are still cap rates, right? NOI is
Yeah.
still NOI. But if you're out there trying to buy apartments based on the way a guy did it in the 90s or 2000s, pre-COVID, right? The nuances of it is just not there. It just doesn't work. So you really need to be current, but then also you want to have the partnerships and the networks and the community around it too. So that's really what launched it for me, was just starting to build a community, realizing the impact we were having on people. And that helped us, launch our own coaching program. But to your point, yeah, we do. We have our meetup, we have our podcast, we do the conference. And then on top of that, with our mastermind, we have our community. We actually just had an event last night where we did a live deal review. So we try to create opportunities to share information, network, we do our wins, live deal reviews, and create partnership opportunities, because that was so critical for me to get started, right? If you think back, one, having that mentor, my mentor hosting kind of his event, me connecting with this group at that event, breaking bread, grabbing dinner, fast forward to me launching my podcast, talking to this individual, we ended up partnering on this deal. And then from that experience, I ended up launching kind of my own deals as an operator. And now today we kind of do both. So we have deals that we lead, but then deals where we will kind of focus more on capital, do some other things as well. But one of the main things we are doing is bringing capital to those opportunities.
Awesome. Yeah, that is a perfect segue because that's the next bullet point I've got in here. I'm like,
Yeah.
okay, so deals since your first one, that 192 unit, and you said you did another one. Was the other portfolio play right after that, and you were still co-GP on that, or what was
Yeah, that was definitely a GP opportunity. That was probably about a year after that one, I think. So I
Okay.
think we did that one. About a year later, they brought that opportunity. Shortly after that, we bought a 28 unit as a
Okay.
JV deal with one investor. We've done like a dozen partnership deals since then. So we've done got an 81 unit down in Florence, Kentucky, 104 units in Louisville that we're on the lead operator team on, and then a couple other deals where we are, general partners on.
Yeah. Okay. That's what I was going to ask, the markets that you're in. So,
Yeah.
yeah, I guess walk us through then. So, on the 28 unit, was that the first one you were the lead on since your 8 unit that you purchased?
Yeah, it was. It was. So that was the first one we took the lead on. That was a deal in Cincinnati. And like I said, the raise on that one was a little smaller. So we had one JV investor
Hmm.
come on board. We put up some capital. They put up the majority of the capital. And then we kind of ran that opportunity. And, we sold that for 2.5 times what we bought it for.
Nice.
Was that last year? Maybe it was 2022. But
Yeah.
we just sold that one. So, we're able to cash that one out and move on to the next opportunity.
Yeah. Awesome. Okay. So let's talk then about deal flow. Again, you got into the market. It's
Mhm.
ramping up. It's getting hot. It's getting hot. 2021, 22 roll around. Everything's exploding in prices. Now, what's happening? What does the portfolio look like? And are you guys executing deals now, or are you biding your time, waiting for deals? Like, what does that look like?
Yeah, so philosophically, two things have happened, right? So for us, we've been investing in this space for 8 years as far as the larger commercial stuff. For 6 of those 8 years, we've been told that the crash is coming, the doom is coming, right? We
Hmm.
talked to experts in the industry. I remember in particular, I think it was 2018, very well-known person. I had a chance to talk to him at a conference, and I was talking about the 8 unit we owned, and they're like, "Oh, you need to get out of it now. Like, oh, it's about to be bad. It's about to be a bloodbath." So we kind of panicked, like, well, this person clearly knows what they're doing, right? Like, we need to get out of here, right? The market just shot straight up from there, right? So
Did you
I
sell?
think we sold that one, but it
Yeah.
was a multitude of reasons. But that feedback was kind of
Yeah.
the icing on the cake there.
Sure.
One of the main reasons we sold was we wanted to be liquid to start scaling up. So we actually used some of the funds for that to buy the 28 unit. But the point I'm making here is that you have to ignore the chatter about where the market is. Prices have been heating up for literally a decade, right? So if you're waiting for that dip, even now, where by all accounts, this is it, right? We're
Mhm.
supposed to see this dip now, right? We're seeing rent actually decline in some markets. Well, in my markets, we're not necessarily seeing it to that extent. But nonetheless, my point is we have an always on strategy where we're constantly looking for deals and opportunities. We want to be mindful of the long term approach, and we're not trying to time the market. I think people get caught up because they're buying properties and they want to flip them in 24 to 36 months. And if you're doing that, you have to time the market. You've got to be right. We take more of a longer term approach. We want to sell in maybe a 5 to 7 year time frame. But if we have to hold it a little bit longer, we can make that work. And I think that's really the difference from a timing standpoint. Our current portfolio, we have 5 properties. We actually are investing final on another opportunity I'm supposed to hear by the end of this week. So we should hear that one. That was a larger property in the Columbus market. So
Okay.
we're definitely active right now looking for deals and opportunities and submitting offers and LOIs. And I'm a firm believer that there are going to be some great opportunities over the next 12 to 24 months. So we plan on doubling down on our efforts and making sure that we're well positioned to take advantage of it, recognizing that, some folks are going to have to sell properties or decide that they want to step out of the market. But when you have that, I want to call it fear, but when you have less demand and less competition based on the economic environment, that's where you're going to get opportunities. So for us, it's a time to double down and be more aggressive with our actions, not with our numbers, but with our actions, as opposed to playing it super cautious with our actions and trying to sit on the sidelines.
Yeah, I agree. So are you guys building up and you're having the conversations and saying, hey, be ready, be ready. Capital sitting on the sidelines, be ready. We're going to find a deal. Or have you set up some sort of a fund vehicle where you can park their capital and have it ready to deploy? Like which way?
Yeah, so our approach is we do it, in a syndication style, and there's
Okay.
certainly advantages for doing a fund. I mean, what you're referring to is basically you create a fund, you raise the money, and then it's already there ready to deploy into a deal. We still do it deal by deal. We
Okay.
find a property, we like it, we reach out to our investor database, raise the capital that way. One of the reasons I like that approach still is it doesn't put pressure on us to put that capital to work. I think sometimes when you raise the money and it's sitting in the account, you feel obligated to put it to work right away.
Hmm.
And I think it almost incentivizes people to make a deal work
Yeah.
as opposed to kind of staying true to their approach and their process. So that's one of the things that we try to stick to. Again, if we get to the point where the deal flow is so tremendous and we really do need to have that advantage of being able to move faster, that's certainly something to consider. But at this point, we don't think it's a need at this very moment.
Yeah. Yeah. Got it. Yeah. I just didn't know what you meant by you're staying ready with your actions. So
Yeah, but let's talk about that real quick though,
sure.
right?
Yeah, go
So
ahead.
when we stay ready, there are a couple things, right? One is actually analyzing deals, talking to brokers, like having your pipeline and your system set up. And in the past, I mean, we would look at a deal and you'd be millions of dollars off from where we think there's value and where the broker thinks there's value. That gap has shrunk. Brokers are now calling us. Brokers didn't call before, right? They sent out a deal. You better reply and get your offer in or whatever, right? Now they're calling us, hey man, did you have a chance to look at this one? Right? Like, I'm like, man, you got my number? Like, I've been trying to call you for 3 years, right? So now that chase has shifted, right? It's almost like the pretty girl in high school, right? So that's changed, right? So now they're calling us, they're reaching out. So that's part of what I mean by being ready is actually having the ability to look at these deals, these opportunities, and underwrite them. The second part of that is making sure you're talking to investors. Investor sentiment has shifted. Many folks will tell you that it was quote unquote easy to raise capital in recent memory. I don't like to say that because I think it discredits the approach to raising capital. Certainly, you may get yeses a little quicker than in the past, but I don't like to use the word easy. I don't like to use the word hard either. So the truth of the matter is, maybe it didn't take as much effort in the past. It's going to take more effort now, which means you need to have more conversations with people. You need to educate people more. You need to let them know why now is a good time to invest, even though everything you read in the news says it's not a good time to invest, right? So that's what I mean by being prepared is having some of these conversations, making sure you're dealing with these investor objections early so that when those opportunities arise, they're ready to invest and not asking you 20 questions because they saw on, the cable news network that the market was going to crash.
Yeah, for sure. Let's shift just a little bit.
Yeah.
Deal flow and acquisitions that you guys have made maybe in recent history, right? 21, 22, 23. Have you had any issues with them with the increased rates? Did you do anything on short-term, bridge debt type stuff? And
Yeah. So,
if you had any challenges, how did you guys deal with them?
so recent deal flow, do we have any challenges, particularly pertaining to the debt? So we try to stick to our fundamentals on deals, and there's only a handful of ways a deal can go bad. And, the interest rates certainly are hitting a lot of people right now. We have, I think, 3 deals that have floating rate debt. On all 3 deals, we had cap rates, or I should say rate caps
Yep.
on them. And on top of that, we had a very clear strategy of why we felt that floating rate debt was still right for those projects. All of our deals, none of them are in jeopardy of, losing any value or doing capital calls or anything like that. We had one deal we actually refinanced late last year because we felt like the next 12 to again 24 months, while there's going to be great opportunities, it's also going to be rocky when it comes to valuations. So we didn't want to be refinancing that deal during that time frame. So we actually refinanced that one early because we had already created a ton of value. So that one we refinanced. There's another deal we bought for 18 million. It's already worth around 24, 25 billion dollars. We're either going to refinance that next summer or kind of, hold it and look to maybe exit in about a year or two. So those deals are doing great. Our other deals we actually bought with fixed debt. We've got one project with a 3.21% interest rate that's locked in for another 9 years. I don't have to do anything on that.
Yeah.
So that deal is doing really, really well. And I think it comes down to make sure you understand why you do what you do. It kind of goes back to that confidence. You can't just blindly follow someone else. And this goes back to being on a journey to mastery. When you have the right people around you, you have to develop a criteria and a strategy that fits you in every aspect of how you are going to invest. That is based on the market, that's based on the asset class, that's based on your investor demand or sentiment, it's based on your operational skills, your team members. You have to take all of those things into consideration on how you want to invest. I'm in the Midwest primarily. So we're in Cincinnati, Louisville, Columbus, our core markets. We love Indianapolis as well, but we don't own anything in Indianapolis right now. And then we do have an investment in Charlotte. We do have one in the Atlanta, Georgia markets. But in my Midwest markets, they just don't grow as fast as maybe those coastal markets or the smile states. There are pros and cons to that. Our highs are not as high, but our lows are not as low. We have a lot of stability in our growth. So while some markets are now experiencing rent decline, we're still seeing rent growth. As a matter of fact, I was just looking at a data point for our Louisville project, the submarket we're in still has a 3.7% vacancy rate, and it's still growing at about 4 or 5% annually as far as the rent goes. So real estate is very local, but you also have to have a plan that matches that, because I'm not going to expect rents to shoot up or appreciation to shoot up crazy. I can't buy based on a 3.5 cap exit rate, right?
Sure.
We're going to buy it for cash flow first and foremost. We want to make sure the property is cash flowing, but we also want to be in an area that does see strong demand. And I think sometimes people have this misnomer that, oh, Midwest markets are only great for cash flow. Well, if you're in Gary, Indiana, yeah, sure, right? Because you're not going to buy that and then sell it at a 4 cap in the future. But we're still in those growth markets, markets where there's strong demand and there's a great blend of cash flow and appreciation. Not to mention ease of doing business in the markets where we're focused on as well. So if you understand that strategy and you put it together, I think you can do really well. And I think we have actually felt vindicated that our strategy does work and is really conservative. And it shows that none of our deals are in trouble at this point. We're cash flowing on pretty much all the deals outside the ones that we're still stabilizing. So we feel really good with that strategy. And I think it empowers us to say, now's the time to be a bit more aggressive, because we've already taken the punch from the market, right?
Mm-hmm.
If the economy softens, well, everyone's underwriting more conservatively now. So we're going to be in a good spot, because that's how we were underwriting a year or two ago as well. So we missed out on a lot of opportunities because we were not assuming some of the growth that maybe some of our counterparts were expecting. So I feel pretty good about it. And I think our portfolio is in a really good position based on that.
Yeah, that's good to hear, because again, with the increased cost of capital, the rates going up, insurance going up, all the horror stories that you hear, right? The fact that you guys haven't done a capital call on those bridge debt deals is incredible. I want to touch on that just a little bit, because it really is. So many people are struggling with it. I hear it in the groups that I'm in here in San Antonio, and guys that have bought things in the last like 3 years, 2 years specifically. But when you were going into those deals, were you buying them with such a low basis that you knew no matter what, if it went up, you guys were going to be in a good spot because it's going to appraise? Because some guys, I'll tell you an example. On a deal that I'm on in Atlanta, the assumption was we're going to go in, we're going to rehab this building, we're going to increase the rents. All these things are going to happen. And then rates went up. They were unable to get the draws from the lender because they were holding on to that capital. So we couldn't get the rehab done. And so then the deal just kind of stagnated. Couldn't get the tenants in, couldn't increase the rents, couldn't do anything. And so again, how do you avoid that, or how did you guys go into that? It's a big question for maybe a very specific deal. So
it's a phenomenal question. And to help the audience, I want to give a broader answer, then I'll drill down if that's okay.
Yeah.
So I mentioned kind of earlier that there are really only a handful of ways commercial multifamily deals go bad. One of them is negative cash flow, right? So negative cash flow is one. The second is having kind of major expenses that were not anticipated, right? So you didn't plan on roofs, you didn't plan on whatever CapEx items, and you don't have the capital to do it. And then the third is going to be having that loan called at an inopportune time. So what you're talking about, it's number one with a little bit of a combination of number three, right? Because you have a 3-year bridge debt term, you know that it's got to be a certain valuation by at the end of year 2 or year 3. You're trying to push the NOI there, and the property's not there because the capital you thought you were going to have to do renovations, you've had to save to pay for this higher interest rate. So let me back up. So when you've got those three things, well, now as an investor, our job is to say, well, how do I mitigate these three risks individually and collectively, right? So on one, cash flow, if you focus on properties that cash flow, that's the very first thing, right? If it's not cash flowing now, what do we need to do to get it to cash flow? What if I'm wrong? What if my time frame is off? What if my renovation budget is 50% higher than we underwrote? You have to have a plan for that. Like that, some of that's going to happen. When you're betting on an operator, you're betting that they've processed some of this and have a plan B, a plan C, and plan D in mind. So that's the first thing, just cash flow. How do you make sure this thing's cash flow? When you get to B, and you think about those costs, all right, well, you got to have reserves. What's your CapEx budget? What do you have in reserves? Your insurance policy, make sure you have proper coverage there. Those are the three things that are going to help protect you across from those expenses that you're not anticipating. I would almost lump in the interest rate in there, right? Having that interest rate cap, having, again, whether it be interest rate reserves set to the side. If you know you're going into bridge debt, depending on when you did this, if interest rates are already starting to move, when you did this, like you should have known that. You should have planned for that. Those were funds you should have set aside, right? And then in the third bucket, and maybe you didn't know, so I don't want to say should, but that was information and something that you could have maybe figured out, some people got completely blindsided
Yeah.
and didn't plan for it. If you bought something in say 2021 and like that makes more sense. But the third one there on the loan, that's where everyone's getting caught up, right? So they're asking for extensions now because the loan's coming due, the value's not where it needs to be, demand's not there. Not to mention, maybe they assume that they would refinance with a 75% LTV, and the bank's like, no, we'll give you 65 or 60, right?
Yep.
So there's a large gap, and people are having to do cash in refinances where they're
Correct.
bringing money to the table to reach that LTV that the lender is looking for. And they're doing capital calls or having to figure out where they're getting those funds from. Maybe it's a private equity investor. So how do we avoid it was the question you originally asked, right? Part of it when I'm looking at deal and opportunity is I'm trying to understand and weigh those three different options. Again, most of my stuff, we focus on stabilized cash flow. If we are going to do a bridge debt, I want to understand, do we have a rate cap? Do we have reserves? And then for me, this is a personal thing. I would only do bridge debt if we feel we're creating a significant amount of value and we need to do it. I mean, the reality is you need to create that value. Like if you're doing a bridge debt, you're essentially banking on being able to create enough value in the future to offset the additional amount of risk by having a loan that could be due in 2 or 3 years. So you have to find a way to execute on that. You're right. There are a number of people who had to use that renovation budget to cover the interest rate increase. And that's a recipe for disaster when you're taken away from that budget. So we didn't have that. That was something that we did. I would tell you, every project we have, even with bridge debt, there's kind of a caveat to why we were okay with it. Okay. So there's one where the interiors were already done and the work we were doing was to the exteriors only. We raised the capital. It was all exterior work. It was all kind of curb appeal type things. And we felt like there was a big rip bump we could get by just operations, driving operations better. So that one felt pretty comfortable. The other one where we did bridge debt, we are pushing rents. We thought we could push them $300 when we bought it. We're actually pushing rents about $700 or $800 right now.
What
So
market is that?
it's here. It's
Yeah.
on Florence. It's on the other side of Cincinnati.
Great.
And those are townhomes. So we bought it. We knew there was good upside. I mean, I had no idea it was going to be this much upside, right?
Yeah.
But we felt comfortable because we were seeing, okay, there's strong demand here. Let's push this. Let's get this done. We're okay being in this environment because we know we're creating enough value based on what we're seeing so far. And then on the last one, it's a little bit different because it has an affordable housing component to it. So that one's a little bit different on our exit options, but we feel pretty comfortable there as well. So I would just say if you're going to do bridge, I mean, there's a very realistic scenario that you at least have to explore to say, what if we're not able to get the NOI where it needs to be when it's time to refinance? Like, if you don't have a plan in place for that scenario, then I would be concerned. I would be very, very concerned. And it may be, hey, we're going to raise X amount of dollars to get the, you can't drive the NOI any further at that point, but maybe it's to get the LTV here so that we can lower our payment or get this kind of loan. And if you communicate that up front, investors won't be upset if you tell them, hey, here are all the possible outcomes. Here's how we're going to address this. Here's how we're going to do this. People just want to be clearly communicated to, right? They're big companies that are losing money or not performing well in the stock market, but they're trusting us as operators to kind of understand this space, and simply saying, well, we didn't know what was going to happen with interest rates. That's not going to make people feel good, right? It may be true, but that's not going to make somebody comfortable and excited to work with you in the future. So it's not to say we were lucky, or I hope I don't come across like I'm implying we're smarter than other people or anything like that. It's not. We just have kind of my principles on how do we protect money first and foremost. That has helped me, protect and save money, and partially because I've lost my money on passive deals with other people before. So I've learned like, all right, you know what? If I follow these values or these core sentiments, that really alleviates a lot of risk from my standpoint. It's not to say we won't do deals that have some components of that, but then I'm going to drill down a little bit deeper on how do we mitigate that risk.
Yeah, for sure. Love it. Look, we'll wrap it up with this. On the market, what you're seeing right now and kind of what you guys are doing on deals that you are syndicating. You said you have one that's in the LOI. You think you're best and final? Is that what you said?
Yeah, we just had the best and final interview. So we're fairly confident we're going to win this one. My partners have actually transacted with the seller before, so we feel pretty confident on that, but it's, who knows, we'll see.
Sure. Okay. But assuming you get it, What are you doing 506B? Are you doing accredited only? Like what type of raises are you doing? And then what does that look like if you can talk about it on the
So
investor return profile?
yeah, I can't go too deep on this particular one, but I would say, yeah, in general, we look at every deal and we kind of make a decision of what's best for the deal. So is this a 506B deal, a 506C deal? We did a C deal on our Louisville project, partially because we felt it was very attractive. It was a newer construction project. It looked great in pictures, it was a lower, I should say it had a higher floor, right? It was already performing okay. We didn't have to go and renovate really. It was more of an operational play. All we did was add backsplashes, right? I didn't do anything else to it. Oh, well, that's not true. We did backsplashes and we added a dog park. So
Nice.
those are the two things we did as quote unquote value add. It was really more operational. We bought it directly from the developer, but I felt that played well for someone who maybe we didn't have a deeper relationship with, for them to see it, understand the play, and say, oh, that makes sense, right?
Yeah.
When you're going with a little bit more work or deeper value add, then I think that people need to be maybe a little bit more comfortable with you and the plan. You want to cast maybe a little bit wider net. So on those deals, and not just that, but I'll say too, I always want to help people who are kind of in the position I was when that last company went bankrupt. And some of these people are not accredited just yet, but they know real estate can help them grow and scale. And you'd hate for them to enter a deal and not know what they're doing because they have zero experience, right? How can they be confident or credible with no experience, right? So if we're kind of their conduit to real estate investing, well, they can learn while they earn. And we always want to have some options available for those people in our network. So we try to make sure we do have some 506B deals as well. On this particular deal that we're talking about, we'll see what that final thing looks like. We are looking at some private equity, kind of do a bit of a staggered or, different capital stack. But typically on our deals, we'll do a 70-30 split with maybe a 7% pref, 70% of the profits going to LPs, 30% going to GPs or the passive investors.
Yeah.
So we'll do that. On the last deal we did, actually, we did a 10 and 50. So we did a 10% pref, so higher pref, but a 50-50 split on the profits after that 10 pref.
Yeah.
And that was very well received. I like that structure. It's harder to find deals where that makes sense, particularly where you get enough cash flow to be able to justify that. But I like making sure that we align our interests with our investors so they know that we're going to get the bulk of our profits after we deliver for them. That's something that we believe in. I know some people don't like a pref. I don't like a pref when it stresses a deal, but I do like a pref when it kind of gives us an incentive, if that makes sense.
Yeah.
Sometimes people, they add a pref where it really hurts the deal and almost makes it harder for that operator to get any profits. Those are deals that we would, I would see more risk because now you've got somebody who, if a deal's not performing to a certain level, they may not make any money.
Yeah. Incentives are not aligned.
Yeah. If you're working on a deal as an operator and you're not going to make any money, I mean, how hard are you really going to work? And I'm not saying they won't work hard, but I'm saying it's a little different if you're not making money. Like you're probably more inclined to say, let's just sell this thing. Like I'm not going to make any money anyway. So as an investor, you want to make sure that that operator has some skin in the game. And I think too often people hear that and they assume it's, oh, they put money into it. I want to make sure they got more than that, that they've got some reputational risk involved, that they have an incentive to make sure they deliver for me as an investor, and that they're doing this professionally. They're building a company and this is what they plan on doing. I don't want someone who has one foot back in corporate America if this doesn't work, right? I want someone who is committed to this space, making these deals profitable, who has invested time, energy, and money, building a personal brand, building a reputation. Those are the people I want to bank on because they've demonstrated a level of competency as well as commitment to ensure that my investment is successful.
Love it. Burn the boats. Do it. John, it's awesome catching up. Very well spoken. And the way you describe every part of what you're working on and what you're doing, it's very helpful and easy to understand what you're working on. So I really appreciate it. Thanks for jumping on, sharing your information, your knowledge, talking about your business, what you guys are doing. Your contact info is going to be in the show notes. Anybody looking to invest, John, Casmon Capital, reach out to him.
I appreciate it. Thank you for having me on, Randall. Great conversation today.
Great catching up.
Did you know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional? If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.